Welcome, ladies and gentlemen. Today I like to talk about the current situation in Germany with regard to trade credit insurance. If we look into the last year, 2019, trade credit insurance in Germany covered receivables in the amount of 422 billion euros. This year, federal government negotiated with the insurance companies reinsurance of approximately 30 billion euro that should prevent from limit cuts or limit reductions. Federal government thought that both would have a negative effect on the German economy. In return to this reinsurance or guarantee, the trade credit insurance company have to transfer 2/3 of their premium to the federal government. As a second measure, the obligation to file for insolvency was postponed by the government until the end of the year of 2020. That means in 2021 we will see a rising number of insolvencies in Germany. If we now try to analyze the trade credit situation in Germany, we have to consider the tasks that such trade credit insurance performs. First of all, of course, it covers the losses of the receivables with exception to the deductible. The second aspect is that with a protected default, payments by the credit insurers are made for those customers that are not paid by their customer if that exceeds 120 or 150 days. And the third function is that the trade credit insurance handles the credit check. If you look now into the developments throughout the year 2020, we can say that most of the credit insurers have granted appropriate credit limits and made only moderate limit reductions or limit cuts due to the economic situation. Of course, in the international market, due to the lockdowns and to the difficult economic problems, we had stronger reductions. However, it was a completely different situation if we compare it to the financial crisis that occurred in 2008 and 2009, where a lot of credit insurance companies cut the limits over complete industries. These days we find only few credit insurance companies who do it this way. The reduction of risks in industries and regions for single companies makes sense, of course. From the customer's point of view, at a first glance, this seems to be very unattractive. But if we take a closer look, we always have to ask the question if the margin that results out of the sales that could be made before is higher compared to the deductible that needs to be paid if the credit insurance has to pay for the bills. In the long term, however, every credit insurance company will say goodbye to a company that is in danger to file bankruptcy. And these days, this is much more differentiated than compared to the situation in the financial crisis. In addition, the federal guarantee helps in two ways. On the one hand, you can see that some credit insurance companies take higher risk on the books, and without the guarantee that wouldn't have been possible. And on the other hand, you see that these companies also stay longer in risk before they cut them. Both is in favor for the customers. And finally, we have to consider that the volume of the 35% of the premium that still stays with the credit insurance company is needed to cover a bigger part of the administrative costs and also the amounts where the default exceeds the agreed guarantee. And we have to have in mind that we are in a situation where we do not have real role models that allow us to do calculations and that allows us to bring in our experience. So let me summarize. First of all, I think many risks would not longer be supplied today without trade credit insurance, or suppliers would suffer severe unexpected losses. Without protected default, some customers still would wait for the payments of their customers or would even suffer liquidity problems. After all, we are in a situation where no experience exists. In this situation, the trade credit insurance has a contribution to stabilize the markets and to stabilize our economy. That's my result. Thank you for listening. Have a good day and stay safe.